Let's move on because I want to talk about another warning on private investments. And as I said, we do warn about these a lot. These are terrible. I remember hearing about a company by the name of Yield Street a few years ago and how it was a new way for small investors to get access to private investments and diversify away from stocks. I don't get that. Why diversify away from stocks? If you pick the right ones, are pretty good. But the company promoted their platform with a tagline, invest like the 1%. Well, what do they mean by that? They're saying invest like the wealthy. And I hate that sales pitch.
That's all it is. It's a sales pitch. I mean, it just irks me when I see stuff like that. And then especially, you don't want to be all in stocks. And it's like, why?
If you pick good ones.
Yeah, you pick good ones, exactly. But that's a selling ploy to a lot of people. People that got burned years ago in stocks, and they're like, I probably shouldn't be all in stocks. So, I'm going to try this new thing, and I get to invest like the 1%. And it just... we'll get to the story on maybe why it irks me even more. Several investors may have lost everything they invest in the platform. One gentleman shared with CNBC how he invested $400,000 in 2 real estate projects. One was a luxury apartment building in downtown Nashville, and it was overseen by former WeWork CEO Adam Newman's family office. Number one, I don't know why we would have gone with that because that guy kind of had some issues when he was running WeWork, but that was a huge collapse that happened. But, I mean, you hear the word Nashville, and Nashville was a hot place and apartment. What could go wrong? And then there was also a 3-building renovation in the Chelsea neighborhood of New York. And this is what allured this gentleman in particular to this investment, was that each project had targeted annual returns of around 20%. Wow, that can't be risky, right? Well, unfortunately, after 3 years, Yield Street declared the Nashville project a total loss, which wiped out $300,000 of its funds, and the Chelsea deal needs to raise fresh capital or it will face a similar fate.
And, and people hear real estate, and they hear that 20%. I've seen them like, well, that's a good return. But I think you said the words you used was targeted return. Right.
Targeted.
So it's
not guaranteed.
Not guaranteed. And again, if it is, people say, it's guaranteed. What is it guaranteed by? A company or a real estate development company or somebody that it's not like the government guarantee where the government have to go broke. I mean, these guarantees I come up with, like, it's only backed by as good as that company is. And many times they're so leveraged and so much in debt, they can't make that guarantee for real.
That's how you lose the money.
Yeah.
Is that the project could be potentially profitable, but they leverage it and they put all this debt on it. Can't repay the debt, and then all of a sudden it's gone.
Yeah.
And it disappears. And the debt is just such an awful thing. You don't think about that when you're doing these deals. And it just drives me crazy when I see people do these things. And I'm going to say this is the fault of many investors as well. You hear all these things and you think that this is different, that you're going to get a 20% return when this basically happened when the 10-year treasury was maybe around 3%.
Right.
That is the only thing out there that I would constitute as risk-free. So you're getting nearly 7 times the risk-free rate. There's risk in that. Come on, man.
And I learned a long time ago, if you can double the risk-free rate, you're doing pretty darn good. And we generally tell people we'll average 8, maybe 10, maybe 12% on average. So we're in that line there. But, Chase, what's a shame is he's not alone. And CNBC reviewed documents that show investors put more than $370 million into 30 real estate projects that have already recognized $78 million in defaults in the past year. And Yield Street customers, well, they weren't very positive. They said, they spoke to CNBC. They said, well, we anticipate deep or probably total losses of the remaining amount that we have with them.
Yeah, the remaining $300 million is still in question, and they think that'll disappear too. And when I looked at this platform, I mean, it's not just real estate. There was also private equity, private credit, art, crypto, and other less common investments. I even saw one, they were doing financing for some boats, for some like massive ships that just got lost in the ocean.
Oh, wow. That's a good investment. Gee.
And it's like, what the heck? And I mean, Yield Street, they make their money by charging management fee of around 2% on invested funds. So it was a heavier management fee as well. But the craziest part to me was in several cases, Yield Street went to its user base to raise rescue funds for troubled deals and told members the loans combined the protections of debt with the upside of equity. But in one case, a $3.1 million member loan to rescue that Nashville project was wiped out after just a few months. So let's phrase it this way. we failed. Can we get some more money to try and fix our failure? That's basically what they're saying. And then just months later, oh, we failed again. We're so sorry. I mean, it's
and these people are such good salespeople. They can, sell you oceanfront property in Phoenix. I mean, that's how good these guys are. And when you hear, our warning is, we're telling you, we're backing this all up, but our warning is when you hear private, I don't care if it's real estate, private equity, private loans, stay away from it. I mean, one of the big problems with these platforms is professional large investors are more disciplined when looking at investing in this space than the smaller players, maybe getting the bad deals that are passed over by the more established players. So they're getting the low-hanging fruit, I guess, is what they're getting. It's unfortunate to see people lose money like this, but this is why we avoid, at Wilsey Asset Management, we avoid 100% the private investment space. There's just not enough clarity, and in many cases, these platforms seem to be in it for themselves rather than for the investors, trying to just rake in the fees. We will continue at Wilsey Asset Management to invest in good quality equities. As I worry, we'll continue to hear stories like this from investors who put money into private investments thinking they were investing in a safer asset, just to find out years later there's nothing left. And we've talked about the difference between risk and volatility. This is the risk when you get into these, and it's just such a shame that people like, oh, equities are risky, but I found this thing here, no market fluctuation, because it doesn't trade. So they don't know what the value is. And some of these put on their own stated value, like, well, we think it's worth this.
Yeah, so you're charging 2% on a fake value, basically.
Yeah.
It's not a true market value. It's, again, an estimated stated value. And we had another piece in the newsletter about the Ivy League funds, and all of a sudden they didn't actually get that stated value when they had to go sell. So you make that question of, well, then what is the true value of it, even though they're charging this higher management fee? And the other thing that I thought was interesting with this Yield Street platform is the gentleman that spoke out on CNBC said, at first it was fine. Of course, that's how it generally goes. He was getting these statements and he was getting kind of updates. And then what happens? It's a private investment, so it's not required. It starts disappearing. You're not hearing anything. Can I get my funds back? No. And it's just like, oh my gosh. And locking your money away to anything with no guarantees, it just, I would never do it. I mean, again, I'll buy a stock and maybe even that stock goes down, let's say 10% because it was a improper investment. At least you can cap that loss at 10%, or things change, right? COVID happens. We can get out. We can get into something different that, is not going to bleed to zero. The private investment, you have to.
Right, but we can look under the curtain. We can see the cash flow. We can see the balance sheet. We can see the income. We can read that, yeah, maybe it drops down 10, maybe even 20%, but we can say, wait a minute, this is a short-term problem. Let's buy more of this.
I'm even saying...
Well, but I'm saying with a private equity, you can't see anything. You don't see behind the curtain at all. It's a blind curtain. You don't know what's going on behind the scenes.
But I don't want to say we're perfect. I mean, again, I always tell the example of Carnival Cruise Lines. We bought Carnival in 2019. Right. We had no inkling that COVID was going to happen. Totally changed the business. We did sell Carnival at a loss in the portfolio, but we were able to get out. Difference is if you did a private investment, let's say that just bought cruise liners in 2019. No, sorry, you can't get your money back. You'd probably still be in that fund, or maybe you'd be out of that fund because your money be at zero. I mean, it's just something that the private investments, they can go great for years, but the moment things turn on a dime and all of a sudden they go down, you can't get out.
Yeah.
You're screwed.
And didn't you just get a call? We got a call from somebody that is in that situation where they did a private investment and it's 4 years? And
yeah, 4 years. He's getting a nice 10% yield on it initially. Right. That's how they're sold. And sure enough, the yield stopped coming in, and now he can't get his $125,000 because it is locked away in a private deal.
And I saw this back in the 80s. They're called limited partnerships, where it starts off pretty great. You get the yield and everything else, and all of a sudden, you're right. It just like the yield stops, try to get your money back. And sometimes people don't get their money back, if they got anything back, for 10, 15 years. And they go through court. And by the time you go through court, sorry, the attorneys eat up all the whatever is left there, anything, and you get zero out of that investment. So,
and I just want to add one more thing to that point about how the larger investors are many times passing over these deals. So I'll kind of use this Nashville and New York deal I mentioned. I bet you a lot of larger investors looked at that deal. They ran the cash flow numbers. They looked at the details and said, that deal doesn't make any sense.
Right.
So you're not truly investing like the 1% because the 1% says, no, we're not going to buy that. That's a bad deal. But if you're a smaller investor and you're part of this, I'm going to call it basically a crowd platform where there's a bunch of people that put all in little amounts to try and get into the bigger deals like this, that money has to go somewhere. So are those people really going to look in detail to see what are the metrics, what's the cash flow, what are the good details of this? And then like, oh, shoot, we have, again, $400 million. We got to put it somewhere. So let's go buy that one thing that is available for sale.
And Chase, you bring that up, but you can't. When you look at private investments, you can't see the financials.
I'm saying,
Right.
I think that, again, if you are truly wealthy, right?
The 1%,
if you're
right.
doing these deals on your own,
You are looking at that stuff.
you're looking at that stuff.
Because
If
you
you're
can.
part of a fund,
Right.
you're not going to know that. And the fund manager, they're not going to be like, well, we don't have anywhere to put the money, so we're just not going to do anything right now. No, they're like, oh, we have $400 million. We have to invest it in
Right.
something.
We got to do something with So,
Yeah.
and again, it's a private. You can't see what that private investment's doing. It's just that's why I say stay away. This will blow up. And again, we've had a good economy here. Just wait till things slow down, and they will. You have these slowdowns. That's when this can be magnified. So if you're not in these,
inklings of them,
yeah. And I'm gonna say if you're not in private investments, don't get into them. If you're in them, if you can, try to get out. But you may be in for a surprise.